Assess corporate earnings, economic data showing potential inflation pressures, and hawkish remarks from a Fed official. Gold is down $2.09 the ounce at $17.70. That's a drop of 1/10%. West Texas Intermediate crude down 2.6%, $63.26 a barrel. Again, recapping, 10-year yield 1.62%. S&P down 31, down 0.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Up for a little Heart, Charlie Pellet?
I love Heart. I really do. I remember the band very well from the 70s, and can't wait to hear the conversation this afternoon.
Me too. I agree. All right, lots coming up, folks, right here on Bloomberg Business Week. It is time for the Market Drivers Report. Let's set the Business Week agenda on this Friday. Vince Signorella, Global Macro Strategist at Bloomberg News. It's how I know it's Friday when Vince is joining us. He's on the phone from White Plains, New York. Dave Wilson, Stock Editor at Bloomberg News. He's here in our Bloomberg Bureau. On the phone, though, because we're doing a little social distancing. I thought I saw Dave earlier. It wasn't a mirage. It was the real thing.
I look forward to getting him in the studio soon.
soon. Let's kick it off, though, with the trade. Dave Wilson, what's going on here? Because it feels like we're coming a little undone. Just a little bit.
Just a little bit. I mean, technology stocks arguably have been a bit undone since the opening bell, and actually going back to late yesterday when we got results from a couple of chip makers that didn't go over so well based on their outlook. And we're talking about Skyworks Solutions and also Cirrus Logic. Now, Skyworks is one of the worst performers on the day in the S&P 500, down more than 8%. But Cirrus Logic taking a much bigger hit, off 15.5%. Put that together with Twitter, whose numbers were out late yesterday. They didn't go over well either because they really didn't beat analysts' revenue estimates all that much. They didn't share in the advertising bounty that Facebook and also Google's owner Alphabet had in the first quarter. So people didn't care for those numbers. Twitter down almost 14% at the moment.
Let's not forget, in February, right, they held their first analyst meeting in a long time, in years, set out some really ambitious goals, and I think people increasingly, Tim, are thinking, okay, how do you you're talking about a big boost in revenue in a few years. How do you get there?
Yeah, and Kurt Wagner joined us yesterday and said there weren't a lot of details, at least in the earnings release, about audio, about changing the product, and that's a big question that investors have because Twitter's product hasn't changed significantly since it was founded.
Well, his dog's becoming pretty popular on Twitter. Let's bring in Vince Signorella. I don't know. Does the puppy have an agent yet or what?
No. The agent's dissing me so far. I might have to work around him and get somebody else.
It's a tough industry, man. How do you see this week? There was so much going on. Earnings, Fed, comments, of course, from the president. And then, of course, we're going to have a big week next week with more earnings. And we've also got a jobs report.
Yeah, no, markets are really still trying to figure this out and digest this. You can see the disparity in how the Treasury market today and the equity market today handle the hawkish comments from Kaplan. You look at the initial reaction from equities, and it's understandable. When someone who's on the Fed says they see froth in the market, which is what Powell basically said on Wednesday, and Kaplan follows up with seeing excess risk in financial markets, where you see all of that is in equities, not so much in treasuries. So equities sold off. Treasuries are very steady because the reality of the situation is what Powell did reiterate on Wednesday is lower for longer. So that's not changing that part of the equation. I think the key takeaway, though, given what both parties said, is Kaplan is a non-voter. Powell is, of course, the chair. Stick with the boss where the comments come from. He's speaking next week on May 3rd. Maybe we'll get some clarity on that.
Maybe. We'll see. Yeah. Hey, Dave, come on back in here and talk a little more about earnings because we wrapped up the busiest week of the quarter, I should say, when it comes to earnings. How are you characterizing the way that companies are thinking now about the second quarter and the third quarter and the fourth quarter, and how is that different from what you saw at the beginning of the year?
Well, I mean, there's a fair amount of optimism around going forward, no question. And, just consider how far the analyst numbers have come on first quarter results. We started out with something like 22.5% earnings growth. That's what people were looking for from the S&P 500 around the end of March. Now you're looking at 46% almost. So, it really tells you that companies are doing well at this point. The biggest issue for a lot of them is how to deal with rising prices for things like raw materials and transportation. So an element of inflation, they have to deal with that, whether it means rising prices, for their products, they can pass along their costs or just kind of eating it and maybe having their profit margins come down a bit accordingly. That's really sort of the back and forth we're seeing at this point on earnings.
Forgive me, Dave. Are we seeing growth both on the top line as well?
Oh, yeah. No question that's the case. Just looking at where we are, again, for the first quarter, you're talking about almost 9% revenue growth for the S&P 500. And that's a reflection of numbers already out and estimates for companies that haven't reported yet.
Right.
So, you look ahead, 17% in the second quarter, 10.5% in the third. So there's plenty of top-line growth to go with the bottom-line increases.
Vince, what I love about you and Dave, you guys have both seen so many different market cycles. You talk to market watchers all the time. You blog about it. What are some of the conversations folks are having right now?
Well, I mean, I think people are looking at the data, more or less, and there are two sides to the coin. Number one, data is brilliant. We saw income and consumption numbers today going back, I think the income numbers were back to like 1946 or something like that. Mm-hmm. So the economy is definitely poised to see some really positive spending as we open up. We have New York City opening up in July, so the second half is looking brilliant. The question is going to be, if we get all of this spending through, talking about $4 trillion, is that going to tamper that because you're going to see rising interest rates? I think both will go hand in hand, and I think there's a good second half of 2021 coming.
And listen, Reuters, a headline crossing the Bloomberg terminal coming from Reuters, President Biden set to ban most travel to the United States from India. It is a constant reminder, and every conversation Tim and I have, that, yep, things feel a lot better in the United States here, but we do not get through the pandemic until really everybody, right, Tim, gets through the pandemic.
Yeah, and it comes after the news earlier this week where the U.S. said, hey, if you are in India and you are a U.S. citizen, get out as soon as possible.
Exactly. Hey, guys, thank you so much. Vince, have a great weekend. Vince Signorella, global macro strategist at Bloomberg News. Dave Wilson's going to be back later on with his chart of the day. Let's do the bite of the day.
It's one number that tells us a lot. It's brought to you by GEP. GEP helps businesses transform supply chains with strategy, managed services, and AI-based cloud-native software. Learn more at GEP.com. Today's number, what is it?
It's like a year, 1993.
A good year.
On this day in 1993, computer scientist, it is a year, the computer scientist Tim Berners-Lee released the source code for the World Wide Web, bringing the first internet browser into the public domain. Berners-Lee invented the WWW, originally called Mesh, while working at CERN in Switzerland. What started as a way of internally sharing information between computers ended up revolutionizing the world. I remember early on in my career in business news having to do a primer about what is the World Wide Web.
Well, we know what it is now.
I'm not that old.
We know what it is now, and it's amazing to see what has happened since then. It's everything.
It's everything. It's all over our world. All right, let's go all around the world. Let's get a check on world and national news. Over to Nancy Lyons. She's in D.C. Hey, Nance.
Hey, Carol. Joe Biden's election has done little to slow the surge of wealth among U.S. billionaires. In the president's first 100 days in office, a Bloomberg analysis found the 100 wealthiest Americans added a combined $195 billion to their fortunes. Most of the gains have been fueled by the rise of the stock market. Well, economists are forecasting a strong overall U.S. recovery from the pandemic, boosted by significant government deficit spending. Bloomberg's Irv Chapman has more from Washington.
There is strong support for infrastructure spending, though tax proposals are likely to be modified. Michael Zizas, chief U.S. policy strategist for Morgan Stanley, said in a Bloomberg interview.
If the money is being put to infrastructure downstream to lower and middle income cohorts, that's a higher marginal propensity to consume. At the same time, the taxes are taking money away from lower marginal propensity to consume. All of that should be net additive to GDP.
Because there's still slack in the economy, Zizas says federal deficits are not likely to lead to significant inflation for some time to come. In Washington, Irv Chapman, Bloomberg Radio.
President Biden is in Philadelphia this afternoon to commemorate Amtrak's 50th anniversary. The 30th Street Station stop is part of Biden's Getting Back on Track tour. It's meant to highlight his first 100 days in office and his push for infrastructure improvements. Well, NASA's little Mars helicopter is getting an extra month of flying. Instead of wrapping up flight tests at the beginning of May, NASA is giving the helicopter at least an extra month to tackle tough new terrain. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much for that update. So let's go through a few of the headlines that we're seeing when it comes to COVID. We just mentioned crossing the Bloomberg, coming from Reuters, President Biden set to ban most travel to the United States from India. I've been talking with folks in India or who know folks in India, and it's a really difficult situation depending on where you are. Obviously, a massive country, lots of people, and even if they're vaccinating many people a day, it's just such a large country that to kind of get ahead of it, especially as those cases spike. And the variant, from what I understand, is a little bit more contagious, and so it's spreading pretty rapidly.
Yeah, we're going to get an update in just a few minutes from Dr. Ian Lusbader at NYU Langone. But in the meantime, Carol, it's important to remember here that even though we're doing such a great job with vaccinations and with distribution of the vaccine, it has been a lopsided administration, certainly, because there are only a handful of countries that are doing very well, among them the UK, Israel, here in the U.S., increasingly some parts of Europe, but so much of the world isn't. And I think we are going to continue to see hotspots emerge, like what we're seeing in India, because they're not vaccinated.
Although I'm going to tell you, I've had a lot of conversations with people who are like, I'm not going to get the vaccine. So that whole idea, those conversations about herd immunity and getting ahead of the variants, I think is going to be a tricky one. There is a story, a UK study published today. People who haven't fought off COVID-19 before are still vulnerable to infection from variants after getting the first dose of Pfizer and BioNTech's vaccine, underscoring the need for fast and full inoculation regimens. We've heard this before. You can't just get one if it's a 2-dose regimen. And then New York City.
Yeah, New York City. The office workers' return isn't going to inspire the private sector. That's at least according to Mayor Bill de Blasio. We talked about this earlier. We talked about it earlier this week. De Blasio targeting a July 1st goal to fully reopen the city. And he said that the 80,000 city employees are expected to return to their offices by Monday, May 3rd. That would be an important indicator to the private sector to follow suit after the pandemic kept millions of people at home. Full disclosure, my wife works for the city, and she is soon going to be required to head into the office.
She is. Is she required to get a vaccine? I mean, she's gotten it.
She's gotten it, but I don't know if they're required. I don't know if they're required.
All right. Yeah. Interesting. We're worrying about that. Hey, some parts of the city, including Broadway theaters, full enrollment at school buildings, that isn't expected to come back until September. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
World headquarters, I'm Charlie Pellet. Down Friday, stocks retreating from records as traders assess corporate earnings, economic data showing potential inflation pressures, and hawkish remarks from a Federal Reserve official. Most major groups in the S&P 500 are lower. Energy, technology shares leading losses. Twitter, after earnings, plunging now by 14.1%. Also after earnings, Amazon up by 0.4% this morning. ExxonMobil lower by 2.2%. S&P down 30, a drop of 0.7%. The Dow down 202, down 0.6%. Nasdaq down 120, a drop of 0.9%. 10-year yield 1.62%. Gold down 2.30 the ounce at $17.69, a drop of 0.1%. West Texas Intermediate crude down 2.2%, $63.56 a barrel. Repeating an earlier headline, President Biden is expected to impose new travel restrictions on India beginning Tuesday. This according to Reuters, citing a White House official. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. So President Biden saying it's going to be a tough call on whether to order U.S. troops to get vaccinated. It's funny, Tim, I actually thought the military was already getting vaccinated, but that's not the case.
No, it's not. And look, I think this is something that a lot of organizations are struggling with right now. To what extent can you actually mandate a vaccination?
Yeah, exactly. So we've got that going on. We've got global cases of the virus topping 150 million. India remaining at the epicenter of the pandemic. They reported record new infections today. There's a lot going on. Let's get to it with Dr. Ian Lustbader, as we always do on our Fridays, clinical professor of medicine at NYU Langone, on the phone in Michigan on this Friday. Dr. Lustbader, nice to have you back with us. How are you?
Good. Always a pleasure. Happy Friday, guys.
Oh my God, this has been
This week.
It's been a hard week. Help me out here, because we did have a headline too. Reuters reporting that the president is set to ban most travel to the U.S. from India. So I was having a conversation with someone, and it's like, look, we're doing so great, and he's like, my wife, she's from India. We're not doing so great.
World War II with troop ships going to Europe and so forth. That probably helped spread it. But I think we're going to see continued multiple waves. And unfortunately, without vaccination, you get mutation. And with mutation, you can get resistant viruses.
Right, which is why, yeah, and we're also talking about booster shots and something we maybe will get into in the next block. Ian, sit tight for a second, and we'll come back to you in just a moment. We are talking with Dr. Ian Lustbader, clinical professor of medicine at NYU Langone Medical Center, on the phone from Michigan. But I do wonder, does it ultimately, if we don't have enough vaccinated, does it come back to us? I know Dr. Lustbader is saying we should be okay, but I do wonder.
Yeah, I do wonder too, especially with all the hesitancy that we're seeing, right? The people who wanted to get vaccinated have already gotten vaccinated.
And I'm having a lot of conversations with people who are like, I'm not going to do it.
I'm not.
You're not.
No.
I am like
It's
amazed in different walks of my life. And I'm respecting it because everybody has to make the decision they feel comfortable with. But it makes sense when he gives me 30% under age of 35 declining the vaccine. I get it. I get that number.
Right. It makes sense.
All right. We'll continue talking about COVID-19. You're listening to Bloomberg Business Week. Carol Master, Tim Stanovic, and this is the Friday edition of Bloomberg.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
So we're just going to lay it out. Charlie Pellet gave us a couple of great questions.
Yeah.
He said, when you have Dr. Lustbader on today, you've got to ask him about this. So we're going to do that.
Yeah, why are different people having different reactions to different or even the same vaccines? It's a question that I've been asking a lot of people.
Right? When somebody's like, oh, you got the vaccine? How'd you do?
Yeah, everybody wants to know. And I want to know.
Yeah, exactly. I also want to know about today's trade. Let's get an update on that. We've got about 90 minutes to go here, Charlie Pellet.
And we are lower across the board, Carol Master, on this Friday. Right now, the S&P. I'll give you the numbers first, the why in a moment here. S&P down 28, retreating from yesterday's record. Right now, 4,183, actually Wednesday's record, down now by 0.7%. The Dow is down 187, down by about 0.6%. NASDAQ down 109, a drop of 0.8%. 10-year yield 1.63%. Gold is down $3 the ounce at $17.69, drop there of 0.2%. And West Texas Intermediate crude tumbling 2.3%, $63.55 a barrel. Stocks drop from a record as traders assess corporate earnings, economic data showing potential inflation pressures, and hawkish remarks from a Fed official. After earnings, Twitter shares plunging by 13.8%. Amazon on the plus side, up by 0.5%. We heard from ExxonMobil this morning. ExxonMobil down by 2.2%. Global coronavirus cases have topped 150 million. India remaining at the epicenter of the pandemic after reporting record new infections. And France says it found initial cases of the variant first detected in India and extended anti-COVID shots to all adults from June 15th. Well, fully vaccinated Americans can now go maskless outdoors, but Dr. Andrew Pakosh, professor of molecular microbiology and immunology at the Johns Hopkins Bloomberg School of Health, still recommends caution.
We're not giving people a free rein to just go out and socialize with anyone and everyone. We still have to be careful in terms of who you're interacting with, because we want the rest of the population to also reach this level of immunity so that we can have further blockades in terms of the ability of the virus to transmit. We don't want to rely on one individual and their immunity to protect the entire community. We need other people to get involved in this.
The Johns Hopkins Bloomberg School of Public Health is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Among some of the vaccine names that we track, Pfizer shares lower now by 0.2%. Its German partner BioNTech up 5.7%. Those are the ADRs. AstraZeneca's ADRs up 3.6%. Moderna is up 2.7%. Johnson & Johnson down 0.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you, Charlie Pellet. Let's get right back to it with Dr. Ian Lustbader, clinical professor of medicine at NYU Langone's Medical Center, joining us now on the phone from Michigan. Dr. Lustbader, I want to just talk about reaction to the vaccine, because this is a question that Carol and I have been talking about a lot, and it's a question we've been asking. And I know a lot of people have been asking each other, hey, what was your reaction to the vaccine? Why are some people having such significant reactions to their second shot or even their first shot, and others aren't? And I'll share the example of my wife. She got the Moderna shot. After the second shot, she was really sick for about 12 hours and like nausea, vomiting. And I got the Pfizer shot, and after my second shot, I was achy, but it really went away after about 36 hours.
So, Charlie Pellet, as usual, right on the money, and you as well, Tim. So vaccines and people's responses, not only to the vaccines, but to the COVID infection itself, are very complex. And I don't have a simple answer for you. There's some data that people who've had the virus and then get vaccinated, there's a fair number of people who have asymptomatic COVID may have a more dramatic response. And the composition of these vaccines is somewhat complex. You do have this RNA that's, at least for the Moderna and the Pfizer vaccines, surrounded by what's called the liposome or a lipid coat. And people, any vaccine, mumps, measles, rubella, tetanus, shingles vaccine, all of these vaccines that we give people typically do cause achiness at the site and fever. I mean, you're recognizing a foreign object, a foreign response, an invader. And of course, the body has a variable response to it. What I would say, though, is that most of these are really relatively minor, limited usually to a day or two or less, and that even people who are on some immunosuppression, rheumatoid arthritis, Crohn's disease, other medications, of course, talk to your doctor, seem to do well with it. So my answer would really be individual variation, the component of the vaccine, and just like a variable response to COVID. 99% do very well, 1% do not. And in some ways, it's hard to predict exactly why. Part of it is genetics, but part of it is expected. Any vaccine, any foreign substance, you usually get some immune response, and that's good. You want an immune response.
But does it mean anything if you don't have some kind of response to a vaccine? If you don't kind of feel anything, does that mean something different in terms of your ability to fight off COVID or some other kind of virus?
No, not necessarily. Some people breeze right through it. Some patients have asked about doing testing after. We don't really recommend that. We don't really do that. Most of the IgG COVID exposure shows nucleocapsid antibodies, which means the infection. You can, in some people, if they're really concerned, check antibodies for spike protein. All the patients I've seen who've had the vaccine do show spike protein. We don't do it routinely. So again, I think the data is very good. As we said, out of 200 million shots, only about 5,000 cases of people after either both shots or the single shot, J&J, that is, but the two RNA shots, have come down with COVID. So pretty effective.
Is there any data up to now that shows a different reaction or different reactions in general following Pfizer versus Moderna? Because there is that anecdotal sort of thing that people say, right? Oh, I hear, this shot's worse than the other shot. But is there any data to back that up?
Not that I'm aware of. They're very similar technology, the messenger RNA technology with encased in a liposome. And really what I would say is because it's so unpredictable, we should not really be asking for one or the other. They're all really quite effective. As you have pointed out correctly, don't get lax. In other words, we really need two shots, either 3 or 4 weeks apart for maximal immunity, and that's even a week or two after the second shot. J&J, somewhat different. You still have to wait for that. But no, having fever chills does not necessarily make a difference. There are some people who just don't form antibodies. We see this with hepatitis B vaccine, mumps, measles, rubella. You can give people several shots, and some people just don't form antibodies. Not quite clear why that is.
All right, good to know. Congratulations on the graduation. Thinking it might be your son, but hope you, well, congratulations.
Engineering. Thanks so much.
Really impressive.
Have a good week, guys.
Yeah, you have a great weekend. Stay safe. Of course, Dr. Ian Lustbader, clinical professor of medicine at NYU Langone, on the phone in Michigan today. Always kind of provides clarification.
Also good to know he's traveling.
He is.
Yeah.
Yeah.
He's vaccinated.
We're hearing that from folks.
We are.
All right, you're listening to Bloomberg Business Week. Carol Massar along with Tim Stanovic. Let's get back to world and national news. For that, it's back to D.C. and Nancy Lyons. Hey, Nance.
Hey, Carol. The Biden administration says it will restrict all travel to the U.S. from India, citing a devastating rise in COVID-19 cases and variants in that country. Officials say the restriction will take effect next Tuesday. Well, a group of scientists is calling on the World Health Organization to take a second look at the origins of COVID-19.
In an open letter to the UN health body, the scientists say WHO should look beyond animal sources for the pandemic, and they propose specific steps for a second investigation to take. They include making sure the team can do its research without the unnecessary presence of government officials, removing veto powers from the member selection process, and mandating broad access to data, records, and samples. Earlier this year, a joint mission of WHO and Chinese scientists concluded the coronavirus probably spread from bats to humans through another animal. They said a laboratory leak was the least likely scenario. In Washington, I'm Nathan Hager, Bloomberg Radio.
The Biden administration continues to promote the president's $4 trillion infrastructure and family spending proposals. Republicans say the tax hikes in his plan will kill jobs, but Commerce Secretary Gina Raimondo says she fundamentally disagrees.
Look, the president is actually proposing cutting taxes. He's cutting taxes on a lot of hardworking, middle-class, working-class Americans. He's raising taxes on the wealthiest among us and closing loopholes in the corporate tax structure.
Raimondo tells Bloomberg almost 100 multi-billion-dollar companies paid no federal taxes thanks to those loopholes. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, really appreciate that update. You're listening to Bloomberg Business Week. Carol Massar, along with Tim Stenovic in our Interactive Brokers studio. This story caught my attention reading in this morning. It is among our most read on the Bloomberg. It's about affluent Americans rushing to retire in a new kind of life is short mindset. The unprecedented surge in shares and home values during an economic crisis is easing the retirement path for those who have savings and investments. And this kind of does go to the K-shaped recovery. There are some folks who are financially maybe a little bit older, but in a good way, and they're saying, you know what? I'm kind of done working.
Yeah, and there's some data to back it up. About 2.7 million Americans age 55 or older are contemplating retirement years earlier than they'd imagined because of the pandemic. That's according to government data. They're more likely to be white, a group that typically has a larger amount of accumulated wealth. And many cite the robust retirement accounts. Carol, you mentioned this. And then also COVID-19 fatigue for their early exit. That's according to interviews with wealth managers and federal surveys.
Yeah, exactly. And much like the U.S. economy's so-called K-shaped recovery, we were just talking about that, the pandemic is treating the affluent differently, empowering them to leave corporate life early. Others who lost jobs had to delay retirement or grew discouraged and retired before they were ready. What's interesting is early retirements, whether desired or forced, kind of will deprive the labor market of some of its most productive workers, according to our reporting, and have an impact on the economic recovery that is really still too early to evaluate. Fed Chairman Jay Powell this week citing a, quote, significant number of people saying they've retired as one reason companies are reporting labor shortages, although it's unclear if they'll eventually rejoin the job market. I think we know millions still out of work, and Jay Powell has said until we work that off, you know, this is why they're going to be patient, but we will see how it shakes out ultimately. How many decide I'm going to retire or stay out of the labor market? How many ultimately come back?
That was a big question that I had at the beginning of the pandemic, Carol. It was, what are the permanent shifts that we're going to see? And we're starting to see that play out with some sort of maybe temporary or permanent migration from cities. We're starting to see more younger people move to more rural areas and work remotely. But I'm also wondering if we're going to start seeing people move closer to families and extended families as a result of the pandemic.
Well, and just that movement alone among Americans, we haven't seen that in years. We've been really kind of stagnant. So a great read, among the most read.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. The Dow, the S&P, NASDAQ are all trading lower right now, with the S&P down 27, lower by 0.7%. Stocks are falling from a record as traders assess corporate earnings. Economic data showing potential inflation pressures and hawkish remarks from a Fed official. The Dow is down 187, down by about 0.5%. NASDAQ down 103, a drop there of 0.7. 10-year yield 1.63%. Gold is down 2.81 the ounce. Little change, down by less than 0.2% at 17.69 the ounce. West Texas Intermediate crude down 2.3%, 63.54 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, another one of our most read stories on the Bloomberg, it's about how President Biden's proposed tax hikes are creating a wealth advisor frenzy. It's getting a little nutty out there, Tim.
It is, especially if you have a ton of money. Joel Weber is editor at Bloomberg Business Week, and he joins us on the remote from Brooklyn. Laura Davison is congressional tax reporter for Bloomberg News on the phone from Washington, D.C. Joel, nothing has been, put into policy yet. Nothing has been made law yet, but that hasn't stopped people from freaking out and from advisors from playing therapist.
Oh man, the freak out has really begun, and yeah, I think everyone is just itching to understand like what could happen, what might happen, what the odds are, what they should be doing now. And if you have enough money to have a financial advisor, you are calling them maybe multiple times. And so Laura had the great idea to talk to a couple of financial advisors and get their advice for clients right now. And Laura, tell us what you learned.
So basically what advisors are saying is, hurry up. Let's make a plan, and then we got to wait and see what Congress actually does. This plan that Biden put out this week is going to go over a bunch of revisions, a bunch of negotiations, and probably is not going to look exactly like what the president proposed. So they're looking to pass some sort of plan, September, October, but that could slip. So really there's only going to be a couple months at the end of the year before these tax increases likely take effect. So wealth advisors are saying, look, if you are going to have to sell any assets, take any capital gains, and pay taxes on those gains, let's do that now versus waiting for the next couple of years, because that capital gains rate, will likely increase. It's 20% now. Biden has proposed almost 40%. So they're saying, hey, if you've got some shares that you're going to sell, let's sell them now, pay the tax at the lower rate. They're even saying if you have some assets that have really appreciated recently, think like Tesla stock or Bitcoin, go ahead, sell those, buy it back, and then you've locked in those gains at the lower rate, because who knows what the future beholds.
But it does still seem like, Laura, there is even uncertainty in doing that, because you and our colleague Ben Steverman in the piece raised the possibility that there could be even retroactive changes, correct?
So this is the risk here. Congress could say, this is totally within their purview, hey, the tax increases already took effect January 1 of 2021, which would mean any sort of planning would essentially be moot at this point, and you could actually end up hurting yourself here. Both Biden advisors as well as congressional Democratic advisors have said that they don't like doing this, that this isn't their plan, but, there's always that risk out there until the bill is signed.
The thing I think is interesting is, what about the IRS putting more scrutiny on the wealthy when it comes to their taxes, kind of taking maybe a deeper look? President Biden has proposed $80 billion for the IRS to strengthen enforcement in the coming decade. How worried are they about that, Laura?
This could be a huge sea change. The wealthy and really taxpayers at every level have seen audits drop precipitously, really in the past decade, as the IRS has had its budget cut. They're basically proposing to double or even triple the IRS enforcement budget, bring in new auditors, bring in new data tools to find fraud. And also, one thing that's interesting is having for bank accounts, having some of the inflows and outflows from bank accounts reported to the IRS, so they have a little bit more visibility on how much money investors should be reporting. This would really be a sea change, and if you have a wealth advisor, it's probably also a good idea to make sure you have a good accountant and tax lawyer on hand as well.
Right. Make sure he's doing the right stuff.
And all those people right now are just like, hey, the financial advisors are like, great, I haven't heard from you forever. Thanks for picking up the phone and calling me. We'll come up with a plan now, Jarek. But so Laura, I want to have a better understanding of this. So that's a hurry, wait strategy that they're basically advising. And are there rainy day implications to this? Like, are they saying, like, don't invest right now, like, hold off until we know what's going on? Like, take us through the various ways that they're actually trying to coach people.
So basically, they're telling people, continue as you were. If you had a plan, continue with that plan. But if you're looking to sell something, let's do it sooner rather than later. Get the deal structured so that it can happen by New Year's Eve if you want to go ahead and execute on that. There's really so much uncertainty right now. Basically, every advisor is saying, don't do anything yet. Let's just, create some options for ourselves, look at different planning tools, and then we can make a decision once we kind of have a sense of what Congress is going to do here.
Okay, so I want to also understand like another element, and this part isn't in your current reporting, but I'd like to understand estate tax was potentially part of this first phase of talk. It seems like they've tabled that. Like, what are these financial advisors? What do they have to say about this? The likelihood of a potential estate tax down the road.
Yeah, so the estate tax right now doesn't kick in until you have $11.7 million of debt, or twice that if you're married. Biden left that out of the plan, likely because there's some Democrats in the Senate who would not support lowering that threshold. But he did campaign on bringing that threshold down to $3.5 million, so a lot more people would be affected by that. That is one of those elements where you could see, if moderates and progressives are negotiating over different elements, that's one area, right, that progressives would say, hey, we really want to get this in here. It raises a bunch of money. It would help Biden pay for a lot of his spending proposals. So that's one area that's still in play.
The Tax Law and Jobs Act of 2017, the Trump tax cuts, those are still pretty fresh. So what do advisors say to you about the idea of people just kind of doing nothing, and perhaps even if there are changes, doing nothing and maybe even waiting for a new administration to revert to rules back to today?
So this is the other thing that advisors are really looking at is, if Republicans sweep in, in 2024, do we basically just have a sea change back in the other direction? Which, as we've seen, with the use of reconciliation, this partisan tool to get bills through Congress, if we keep having the pendulum swing one way or another, we could see policy changes on tax and anything, every 4 years changing significantly. And this is something that really has frustrated tax lawyers, for example. They're just finally getting all the details from the Tax Cuts and Jobs Act into place, and now they basically have to totally undo them, and all the advice they had given their clients totally goes out the window. It's very, very confusing and hectic.
Well, the freak out, the frenzy says to me, Laura, that the wealthy do expect some change. Even if the political process may be tough, they ultimately do expect they're going to be paying more taxes. Is that a fair assessment?
Taxes, more likely than not, are going to go up. Which taxes, how much, who's going to be affected, that's what's going to be negotiated over the next several months.
And you know who makes money along the way? The financial advisors, right?
And the lawyers, too.
Listen, it's a great story, and I feel like, Jill, you put taxes in a story here on Bloomberg, and everybody wants to read it.
Yeah, I think the amount of information that we're going to be consuming on this, we were all armchair quarterbacks for the pandemic, on everything about the virus, about vaccines, and now we're entering this new phase where, now we have a new administration, new stuff, and I think, step up in basis is going to be this thing that everyone is going to want to know about. So we're just going to be watching this so closely. It is such a core competency story at Bloomberg, and we'll just own this for the months to come. And I'm sure we'll be reading more from Laura every day. Just keep it coming, Laura.
Explaining it all to us. Laura Davison, thank you so much. Congressional tax reporter at Bloomberg News. She's with us on the phone in D.C. Jill Weber, editor of Bloomberg Business Week. Have a great weekend on the remote access from Brooklyn. Now, for those of you listening in New York, D.C., and San Francisco, watching on YouTube, Bloomberg Business Week is going to continue. If you're listening on Bloomberg 106.1 in Boston, Bay State Business is next. That story, by the way, is online at Bloomberg Business Week. That double issue, though, still on newsstands. A great cover story about Joe Biden's first 100 days and what's ahead for the next 100 and counting. You're listening to Bloomberg Business Week. Carol Massar, Tim Stanovic. This is Bloomberg Radio.
stocks, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We move into the final hour of trading of the month. We've got the Dow, the S&P, NASDAQ all declining right now. Stocks retreating from a record as traders assess corporate earnings, economic data showing potential inflation pressures, along with hawkish remarks from a Federal Reserve official. Most major groups in the S&P 500 index are lower. Energy and tech shares leading today's losses. Twitter tumbled as the social media company posted a sluggish start to the year in its advertising business. We've got Twitter shares plunging now by 13.9%. Also after earnings last night, Amazon on the plus side. Amazon.com advancing by 0.5%. ExxonMobil out this morning. ExxonMobil shares tumbling now by just about 2.4%. Exxon's decline comes as the price of oil drops 2.2%. West Texas Intermediate down $1.42 a barrel to $63.59. Gold down 0.2%, down $3.68 the ounce to $17.68. 10-year yield 1.63%. S&P down 25, down 0.6. The Dow down 0.5%, down 177. Nasdaq down 98, down 0.7. Commerce Secretary Gina Raimondo says the Biden administration needs to help American businesses export to China and do business in the world's second largest economy, even as it protects workers from unfair practices and competition. And in an interview on Bloomberg Radio, she also talked about President Biden's infrastructure plan.
The investments that the president is calling for in infrastructure, in broadband, in job training, in basic research are absolutely vital for American businesses to remain competitive.
And she was interviewed on Bloomberg's Balance of Power. Recapping, stocks lower with the S&P down 26, a drop of 0.6%. I'm Charlie Pellet. That's a Bloomberg Business Flash.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, so definitely a top story this hour. It was a top story after the closing bell, and we're talking about Amazon. They had a blowout quarter, not my words, but analysts and observers certainly here at Bloomberg Intelligence. As a result, shares of Amazon rallied to a record intraday high. The stock, though, trading off its highs of the days. It was up as much as 2.4%, now up just about 0.5%. So let's get into it, because it's a company with a few big moving parts and businesses. E-commerce, of course, Tim, but also cloud.
Yeah, let's get to Poonam Goyal, Senior U.S. Retail Analyst at Bloomberg Intelligence, and Anurag Rana, Senior Software and IT Specialist. Poonam joins us from New Jersey, and Anurag joining us on the phone from Chicago. Poonam, I want to start with you and talk about the retail side of things before we get into the cloud here. Was the biggest highlight from a retail perspective the company's guidance, seeing second quarter net sales between $110 billion to $116 billion, surpassing those estimates the analysts had of about $108.35 billion?
Yes, absolutely. That was the biggest surprise. And it was most surprising because if you look back to last year, 2Q was their toughest comparison. That's when, the pandemic had surged and demand for digital really went through the roof, as most stores were closed in the second quarter of last year. So seeing that the growth only moderated, 10 percentage points, 10, 15 percentage points is pretty remarkable given the comparisons that we're dealing with.
Do you believe it will continue based on your research and analysis and channel checks that e-commerce and e-retail continues to be a big thing on the other side of the pandemic?
Absolutely. Growth rates will moderate in the back half of this year. But that said, we do think that e-commerce can continue to grow double digits for Amazon and for many other web giants.
Stimulus payments or no stimulus payments, right?
Yeah, Anurag, jump on in here and talk a little bit about the cloud side of this, AWS, Amazon Web Services. Until a few years ago, the company didn't even break this out separately, but now this is just an absolutely huge business. It's continuing to grow. The growth rate is slowing. What do you say about increasing competition from the likes of Microsoft and perhaps even Google?
So the market's big enough for all three of them to exist. If you look at cloud as a total percentage of total IT spending, it's still less than 20%. And in cloud infrastructure, it's less than 10% of the global IT spend. So the runway is very long, and all three of them that you mentioned, especially Microsoft and Amazon, both of them have a long way to go.
But what about margins in AWS? With the increased competition, it means that margins could start to see some pressure, right?
So once again, the operating margins for a business like cloud is somewhere around 30-31% at this point for Amazon.
Wow.
And there is no reason that's not going to be the case, a year out, 2 years out, 3 years out. Only because even as you get bigger, you get economies of scale for some of these products. So competition or not, we see no reason why the margins won't be, 30% or above even in out years.
All right. So first, let me put this to you, Poonam. When it comes to the e-commerce retail side of the business, what is it that we as investors need to be smart about going forward and focusing on from Amazon?
Yeah, I think you have to just think about the reach that Amazon still has. Amazon as a percent of total e-commerce sales is still under 30. It's about 30%. So it's not the majority of e-commerce, yet a big number. And their third-party sales are growing much faster than their own business, which just shows that there are new businesses that they can attract and continue to really size that GMV, which is already above $500 billion based on our estimates.
Do they make as much money, though, on those third-party sales?
They do.
Okay.
The take rate on the third-party sales is about 25 to 30% in our view, which is significantly higher than that of an eBay, but that's because they do the fulfillment. So there is also a cost element built into that, which is why the take rate is higher.
Hey, Poonam, do Americans continue to shop at Amazon after the pandemic when they are fully vaccinated, when they are ready to go out to those brick-and-mortar stores?
I think so. I mean, if anything, the 200 million plus Prime members will tell you that they're just used to it now. It's just a part of your day-to-day life where you see the convenience, you see the benefit of just getting things to your door fairly quickly.
So, and I know we're going back and forth because we really do feel like these are the two big businesses when it comes to Amazon. So, Anurag, what about, you mentioned the economies of scale, and that makes complete sense to me. But I do wonder, how much does Amazon need to keep spending on the build-out to be ready, to continue to capturing, that very run, you talk about the run rate being very long. So how much do they have to continue kind of building out to make sure the cloud capacity is there for when it's in demand?
I mean, CapEx for new data centers is just part and parcel of your daily business. In fact, sometimes what could happen is, let's say, hypothetically, you're working with a large bank or a large company, and that company shuts down their own data centers, and then, they move their products or they move service to or their applications to Amazon's data center. So Amazon will continue to invest that, but I don't think that has any impact on either their operating margin structure or either the growth rate.
I am curious, you guys, especially since I feel like last quarter, not the most recent, but the last quarter, it was kind of overshadowed by it was overshadowed by the news that Jeff Bezos was stepping down as CEO. He's still chairman, but we've done a lot of reporting here at Bloomberg that he's thinking about his legacy. Poonam, what do you think he will, or how do you see it that in terms of his continued influence on the company, but maybe at the back of his mind, he's thinking about his legacy?
I think nothing changes really. Okay. I think he'll still lead the company in a meaningful way, and we don't really see much change coming outside of just continued focus on AWS advertising and the online businesses. I think they'll just keep pushing forward to get bigger and bigger.
Hey, Anurag, very briefly here, what is the next AWS at Amazon?
It could be the streaming business as we get more details about how that shapes up, because, I can tell you from personal experience, I know, example in India, the cost of that is slightly lower, considerably lower than Netflix. And once you get hooked into some of those services, you just don't leave them.
Yeah, they're sticky.
Poonam, 20 seconds. What do you think is the next AWS at the company? Just quickly.
I'd agree with Anurag. It's either streaming or advertising. I think that's where the next leg is for growth.
All right. Good stuff. Folks, thank you so much. We read both of your research all the time. Poonam Goyal, she's Senior U.S. Retail Analyst at Bloomberg Intelligence from New Jersey, and Anurag Rana, Senior Software and IT Services Analyst, also at BI, on the phone from Chicago.
Let's get down to Washington, D.C. for a check of world and national news with Nancy Lyons. Hey, Nance.
Hey, Tim. President Joe Biden is helping Amtrak, the nation's passenger rail system, celebrate 50 years of service.
I've been riding an Amtrak for almost as long as there's been an Amtrak. I've come to see that Amtrak doesn't just carry us from one place to another. It opens up enormous possibilities. And especially now, it makes it possible to build an economy of the future and one that we need.
Biden says the expansion of rail, part of his infrastructure plan, will provide good-paying jobs and lower emissions by replacing trucks and transporting the nation's goods. Republicans have launched an aggressive campaign of culling voter rolls and making it harder for people to cast their ballots. They're doing it in the name of election security, but as Bloomberg's Amy Morris reports from Washington, it might just backfire.
Republican lawmakers across the country are checking names against other government databases like death notices, criminal records, and motor vehicles records to determine who can vote. The problem is those other databases might be wrong, and eligible voters could be kicked off the rolls. Nationwide, at least 50 bills have been proposed to trim the voter rolls, and several are already signed into law. Elections officials say voting rolls must be kept clean without suppressing legitimate votes. In Washington, I'm Amy Morris, Bloomberg Radio.
Rudy Giuliani says the FBI raid on his New York apartment this week was unjustified. Donald Trump's former personal attorney appeared on Fox News last night and said federal agents seized up to 8 personal electronic devices from his apartment and his law offices. It was part of a probe into his dealings in Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, you are listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic in our Interactive Brokers studio. This story by Simon Hunt and Ben Steverman. Bloomberg talks about in the president's first 100 days in office, against a drumbeat of calls for the rich to pay more in taxes, the 100 wealthiest Americans added a combined $195 billion to their fortunes, according to a Bloomberg analysis. A lot of that had to do because of the rise in stocks.
Yeah, the market's been going higher since Biden was sworn in on January 20th, also along with the vaccination program's fast rollout. And then, of course, the $1.9 trillion in government stimulus that the Biden administration pushed through. The S&P 500 and Dow Jones indices have both climbed to more than 10% over that period of time.
Yeah, exactly. The combined fortunes of the richest 100 Americans have reached $2.9 trillion, greater than the combined $2.5 trillion wealth of the bottom 50% of the U.S. population, according to data from the Federal Reserve. So we talk about this. We've talked about it with Peter Atwater over at William & Mary, the K-shaped recovery, how some people have not even felt much as a result of the pandemic in the last 12, 13 months, and then many other people, the bottom leg of the K, have felt so much. And a lot of it is depending on the job you do, the field that you're in, and also depending on whether or not you're in the stock market.
And perhaps there's no better illustration of why the Biden administration wants to take this on, not just through thinking about how the country can take, I don't want to say take care, but how the country can address these issues of inequality, whether it has to do with child care, whether it has to do with what the Biden administration considers infrastructure, and, of course, as we talked about today, how to pay for it.
Right, and timely, considering we're just coming off a week and a period of mega tech earnings, and a lot of them just hitting it out of the park. We just talked about Amazon. Biggest driver of some of the ultra billionaires that are out there, of the wealth surge that we've seen, has been tech companies like Amazon, Facebook, and Alphabet's Google, bolstered by increased online and stay-at-home activity during the pandemic. And so they have benefited big time. The FANG Stocks Index, by the way, climbing 94% in the past 12 months, compared with the 45% advance of the S&P 500.
Mark Zuckerberg's net worth rose $8.1 billion in a single day because of Facebook's earnings. This is Bloomberg.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 43 minutes to go ahead of the closing bell. The Dow, the S&P, NASDAQ are all declining. S&P making a run again for the worst level of the day. Let's head right over to the first word breaking news desk. Lots going on. And here he is with today's afternoon call, Bill Maloney.
And good afternoon, Charlie. U.S. stocks under pressure from the start today. Dow is currently down 220 points. S&P's dropped 33. NASDAQ is lower by 132. The U.S. 10-year yield at 1.63%. Gold is down 3, and transports dropped 59 points. Among the main 11 S&P sectors, only real estate, utilities, and consumer discretionary were in the green. Energy led to the downside. And leaders to the upside in the Dow, Amgen and Merck, while Chevron fell 3% after earnings and led to the downside. Also after earnings, Twitter plunged 14%. Amazon is now little changed. And in other news, Kaplan said we've got real excesses in the housing market. Wrapping things up, Bitcoin surged 7.5%. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type squawk SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week on this Friday. And the Bloomberg Big Take today, it's a Bloomberg exclusive that you kind of need to be focusing on. And it's a story that only we have. And today it's about the seemingly nonstop behind-the-scenes drama between Apollo Global Management's billionaire co-founders and what it means for investors.
Heather Perlberg is a private equity reporter at Bloomberg News, joins us on the phone from Washington, D.C. Heather, this is quite a read. I can see why it is the Big Take today. What has been happening behind the scenes as Leon Black has been has exited Apollo?
Well, Leon Black is sort of a known classicist. I mean, named the firm Apollo, and it's really starting to look a lot like a classic Greek tragedy. I mean, you have the drama, the revenge, the power grab, and at the center of it is this, $455 billion investing powerhouse that's really had a tumultuous year or so. And Leon Black was just really sort of scrutinized for his ties to Jeffrey Epstein for most of last year, moving into this year, eventually sort of forced to step aside. And you had his two potential successors, Mark Rowan and Josh Harris. And Mark Rowan, took the reins. Harris had this sort of failed bid to become CEO. And since then, he's really been sidelined. And at a bare-knuckle firm like Apollo, that doesn't look good.
It sounds a little surprising, too. Is it?
Well, you had these three men who were sort of leading different parts of the business. Josh Harris was always in charge of private equity. Now Apollo made this grab for Athene, the huge insurance company that has made it sort of the envy of Wall Street for getting such huge fees. And private equity is certainly a smaller part of their business. And Harris is just being kind of slowly relinquished of duties, shopping for a place in Florida, for a man who was sort of a known workaholic and really micromanaging into the nitty-gritty of deals in the New York office. He wouldn't be moving to Florida if he really had his pulse on the business.
What do employees who work under Harris or have worked under Harris think of that? Because there are some pretty jarring anecdotes in here about what they think.
Well, he wasn't known to be an easy man to work for, and that's been sort of widely reported in the past. But yeah, we did hear some tales of his underlings humming "Ding Dong, the Witch is Dead" from The Wizard of Oz. So I guess they were relieved.
That's a little harsh.
It
to
is
say,
a little harsh.
right?
Charming, right?
Yeah, exactly. When you think about it, as you write and report, this is an individual, Harris, that is, who has spent, you report, years positioning himself and becoming a more public face of the company at conferences and in the media, kind of setting the stage. And it's interesting to see how things play out. And Leon Black, we know, has taken a big step back, but what is his involvement? What are you hearing as things change and evolve?
Well, he really is not supposed to be involved in any investing activity anymore. You know, he cited health issues. There was a story that he had kind of called into one meeting that was quickly reported by the media. And I think there's just so much scrutiny over his involvement that he'll probably stay out of it for a little while. I mean, there's some speculation that he might come back eventually,
right?
But nobody really knows in what form or what that would look like.
I always think about all of the stories that you and your team and others have reported at Bloomberg. You know, those key senior people, they are often crucial when it comes to raising new funds, creating new funds, the relationships that they've had for years that allow them to raise new money to invest. So how does Harris having a much smaller role and maybe potentially no role at some point, how does that impact the firm, which is a publicly traded firm?
At some point, we'll see how that shakes out. I mean, he definitely has relationships with big limited partners, just like all of the founders will have their own relationships with people. And Josh Harris is still a key man on the largest ever private equity fund that Apollo had raised, which, you know, they haven't finished investing yet. So if he were to leave, which, you know, people are speculating he will in the next year or so, that would trigger a big problem for Apollo. I mean, investors would essentially have to sign off on the fund continuing to do deals. So investing would pause or maybe even stop. And Apollo certainly doesn't want that to happen. So he does have a little bit of leverage at the moment, too.
Yeah, stock's up about 13% this year.
Hey, Heather, what did you learn specifically about what Harris is doing in Florida and has been doing during the pandemic, and indications, just in about 30 seconds or so, that he's thinking about making more permanent roots there?
He's been spotted at a lot of different nice restaurants, riding his bike around town in the Palm Beach area. You know, I think there's a lot of people who have sort of fled New York City in the pandemic, and we had definitely heard that he's looking to buy a place down there. Apollo's opening offices down there, so it isn't the craziest thing, along with other firms, to kind of help retain talent. But for someone like Josh, you know, this could be a sign that if he wanted to sell down Apollo shares, taxes wouldn't be as much of an issue as they were in New York.
We'll see if we see him a lot more at sports events, too, as that opens up, because, of course, he's got Harris Blitzer Sports and Entertainment that he set up with Blackstone's David Blitzer. Hey, great reporting, as always, and that, of course, is the Big Take story. You can find out more at Bloomberg and at Bloomberg.com.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Yes, indeed, and it's that time of the day. We're going to check in with Bloomberg Stocks columnist and editor Dave Wilson with his Friday edition of Chart of the Day.
And Dave's here in New York City in our, well, he's always in the New York area, but he's in the studio today.
Yeah,
kind
so,
of.
yeah, he's here.
I feel him. I feel the presence. I'm going to be able to get the song because of it, Carol.
It's been all over Bloomberg TV today.
I know.
All right, so we'll find out what he has in store in just a moment. Right now, though, we've just got about 29 minutes to go in the trading day. Let's check in with Charlie Bell.
Hi, thank you very much. And here's what's going on. The Dow, the S&P, NASDAQ, all declining. We are, however, off session lows. Right now, the S&P is down 26. That is a drop of 0.6%. Stocks declining from a record as traders assess corporate earnings, economic data showing potential inflation pressures, and hawkish remarks from a Federal Reserve official. The Dow Jones Industrial Average down 171 points, a drop there of 0.5%. NASDAQ down 110, a drop there of 0.8%. S&P lower by 27, down 0.7. 10-year yield 1.62%. It is the final trading day of the month of April. Gold down now by $4 the ounce, down by about 0.3%, $17.67 the ounce. West Texas Intermediate crude down 2.3%, $63.54 for a barrel of WTI. So again, a down day. Most major groups in the S&P 500 are lower. Energy and tech shares leading losses. Case in point, Twitter reported earnings last night plunging now by 14.1%. Amazon after earnings up 0.2%. President Biden has banned most travel to the U.S. from India beginning Tuesday as the country struggles to combat the worst surge of coronavirus cases in the world. Fully vaccinated Americans can now go maskless outdoors, but Dr. Andrew Pekosh, professor of molecular microbiology and immunology at the Johns Hopkins Bloomberg School of Public Health, still advises caution.
While vaccination reduces the risks of transmission tremendously, it doesn't eliminate it. So until we get to a level where most of the people are vaccinated, it's still good to have some of these reminders that we're not out of the woods yet. We still have to be careful and measured in terms of how we're approaching this pandemic.
The Johns Hopkins Bloomberg School of Public Health is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Among some of the vaccine names that we track, Pfizer shares down 0.1%. ADRs of BioNTech surging 5.6% right now. ADRs of AstraZeneca up 3.1%. Moderna shares, they're up 1.7%. Johnson & Johnson down 0.7%. Recapping, stocks pulling back from records with the S&P this Friday down 27 points, down 0.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you, Charlie Pellet. This is Bloomberg.
Okay,
Rod
great.
Stewart and Tina Turner.
God,
That's their version of It Takes Two.
I didn't pick up the Rod Stewart sound.
Yeah, well, it was there.
Okay, I trust
you. What can I say? Anyway, not exactly Marvin Gaye and Kim Weston who did the original version, but a cover that got some notice when it was first released.
Why'd you pick that version? Oh, because Tina
Just to be different, because I picked the original before. It's like you got to switch things up.
All right, I love that you do. So It Takes Two, the chart of the day.
Right. In this case, the two are technology stocks and TIPS, inflation-protected Treasury securities. And it's maybe a bit of a stretch to think there really is a connection between them, But Andrew Garthwaite made one in the report yesterday, and he's a global strategist at Credit Suisse, so it got my attention. What he specifically looked at is the relative performance of tech stocks and the yield on specifically the 10-year tips. So, his basic argument is that, if inflation is more of a concern, then it's a situation where value stocks, the ones that are relatively cheap, would do well, and the tech companies maybe not so much. And that's kind of the situation we find ourselves in, except there's sort of one caveat in his view, is that he finds reasons for tips to kind of hold steady here, even if we get more inflation, that there's going to be demand, among other things, from investors, just trying to protect themselves against what may lie ahead. So the chart goes back to the beginning of 2019 and tracks the relationship between tech stocks in the S&P 500 and the broader index, as well as the 10-year tips, whose yield is inverted, just to kind of put them on the same playing field, so to speak. And, the way he sees it, as I'm mentioning, and I'm quoting from his report, we do not expect a meaningful rise in the tips yield. So in other words, in his view, tech stocks can actually expect to get some support from what's happening in the bond market, specifically when it comes to inflation index debt. If you want to know more, folks, send me an email. I'll get you the chart, the explanation that goes with it, and everything I do going forward. The email address is dwilson@bloomberg.net. That's dwilson@bloomberg.net.
So a good correlation, Dave, in terms of an indicator? I mean, what's your, checking history? What are you seeing?
Well, it's more of a recent kind of connection. I extended the chart back before 2019, and they don't sync up quite as well as they have recently. Then again, you think about inflation, it hasn't been an issue for years and years until the last few months. So you can understand why that shift would take place.
Hey, Dave, last day of the month, you know what that means? It's
I know exactly what that means.
Spotify playlist.
You betcha. And in a few moments, you'll be able to find it on my Twitter feed at The One Dave, also at Facebook and at LinkedIn. And coming up at 4:15 Wall Street time, my stock of the day, Oppenheimer Holdings. The investment bank rose to its highest price since 2007 after first quarter results showed a surge in earnings and revenue. And do you believe there isn't a single Wall Street analyst that covers Oppenheimer? It's a Wall Street firm?
Wow.
Years ago, I worked at Wall Street Journal, Dow Jones, and Oppenheimer was in our tower there at World Financial Center, and it was a huge firm, right? It just had it had analysts, it had so much, and it's really changed over the years, Dave.
Yeah, it has. And actually, I was in the same position back in the day, in the 80s when I was working at Dow Jones in the World Financial Center.
Right? They were right there.
Oppenheimer. Yeah.
Yeah. We used to run into all of their analysts and things, and they'd come up the tower and just, come on our shows and stuff. So very cool stuff. Dave Wilson, have a good weekend. What do you got?
Dave, have a good weekend. Look for Dave's Stock of the Day just after 4:15 p.m. Wall Street time on Facebook, LinkedIn, Twitter, at The One Dave.
All right, let's get a check on world and national news. Nancy Lyons in her 99.1 newsroom in the nation's capital. Hi, Nancy.
Hey, Carol. President Joe Biden is back in Philadelphia today, one of the cities that helped him win the White House. He's there to mark the 50th anniversary of Amtrak and to promote his infrastructure plan that sets aside $621 billion to improve roads, bridges, and public transit. $8 billion of that is earmarked for Amtrak.
Today, we have a once-in-a-generation opportunity to position Amtrak and rail, and intercity rail as well, in general, to play a central role in our transformation of transportation economic future. To make investments that can help America get back on track, no pun intended.
Biden's plan would tackle Amtrak's repair backlog, improve service along the Northeast Corridor, and expand service all across the country. Well, Biden's Commerce Secretary Gina Raimondo tells Bloomberg spending on all forms of infrastructure is necessary after years of neglect.
The investments that the president is calling for in infrastructure, in broadband, in job training, in basic research are absolutely vital for American businesses to remain competitive.
And Raimondo tells Bloomberg there is not great evidence that capital gains tax hikes would decrease innovation capital. Well, the U.S. will restrict travel from India beginning next Tuesday. The White House says it's because of the rise in COVID-19 cases in the country and the emergence of potentially dangerous variants of the coronavirus. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. One story that came up on our radar off of the Bloomberg buyer, Natalie Wong. It's about Manhattan restaurant jobs go begging, hobbling the industry comeback. I got to say, this mirrors a conversation. I know you spoke with him, John Taffer, host and executive producer of Bar Rescue. We also talked to him here at Bloomberg Business Week, but he talked about how restaurant owners are having a hard time finding workers. He cited the idea that folks have stimulus payments and, checks and unemployment checks, and so they're going to kind of wait and ride it out before coming back to work.
And why wouldn't they? It makes sense if that's actually the case. I will say too, Carol, in this current edition of Bloomberg Business Week magazine, there's an article about Uber and Lyft and what Uber and Lyft are doing to try to entice Uber and Lyft drivers to come back, because customers are returning at a faster rate as they're getting vaccinated, and drivers are not as eager to actually get in the cars and do the driving.
Exactly. And one Uber driver actually saying that to me specifically, like he thinks about some of the people he picks up and thinks about COVID and whether or not what their situation is. This, though, gets back to the restaurant industry. We heard from New York City, or we know that New York City Mayor Bill de Blasio laying out the timeline for when New York City reopens. So Manhattan restaurants, lost a lot of workers, experienced restaurant employees who fled New York during last year's lockdown. No hurry to come back, while tourists and office workers are still home. And after a year of pandemic pain, the shortage is clouding otherwise hopeful signs for dining as restaurants and bars sign some new leases. Vaccinated New Yorkers prepare to splurge, and the city pushes to fully reopen in July. This is again from our reporting.
Interestingly enough, there are workers who are bound for other areas, perhaps the Hamptons or other hotspots where diners are plentiful and hefty tips are guaranteed. One thing that we asked Taffer about on Quick Take was other areas of the country that he sees as hot. Miami, for example. There are a lot of people moving there, and he does see that as an area of growth for restaurants and bars.
All right, check out more just on COVID and also the reopening. You can do that by just going to the Bloomberg terminal, of course, or Bloomberg.com. This is Bloomberg Radio.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet, just getting word from Washington that people traveling by air, bus, and rail must continue wearing face masks through at least September 13th. That from the Transportation Security Administration. Stocks lower. The Dow, the S&P, NASDAQ, all declining. In fact, we are at the worst level of the day right now on the S&P 500 index. 13 minutes to go ahead of the closing bell. Final trading day of the week and the month of April, with the S&P now down by 34 points, lower by 0.8%. The Dow is down 225, down 0.7. Late day fade here. NASDAQ down 134, down by 1%. Stocks fell from a record as traders assessed corporate earnings, economic data showing potential inflation pressures, and hawkish remarks from a Federal Reserve official. Twitter shares plunging after earnings, down by almost 15% right now. ExxonMobil out this morning, lower by 2.6%. Amazon after earnings, lower now, little changed, have been higher for most of the day. Amazon just turning negative, down by less than 0.1%. Recapping, stocks lower, 10-year yield 1.62%. Gold right now down 0.3, 17.66 the ounce. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive.
Just drive, baby.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Just about 10 minutes left in today's trading session. Charlie Pellet putting it so perfectly. A late day fade here on this Friday. We are definitely off our best levels of the session and definitely off record highs for the broader market. Let's get to it with James Chakmak. He is back with us, partner and portfolio analyst. He focuses on tech stocks at the asset management firm Clockwise Capital. He's back with us on the phone in Miami. James, good to have you back with us. What a week. Tech stocks, this is your world. I'm guessing you might not have gotten too much sleep this week, but sum it up for us, if you would, if there is kind of a big overarching theme from some of the names that reported this week.
Yeah, thanks for having me.
Sure.
We saw all the big companies reporting this week: Amazon, Apple, Facebook, Microsoft. And I think the big overarching takeaway from those is that these companies are proving to be increasingly essential to the world, and the results certainly prove that not only are they essential to the way businesses operate and consumers, but they're essentially the new utilities. And that essential infrastructure that they've built is something that's going to be virtually impossible to derail for the foreseeable future. And the new companies that are coming into the market are predicated on leveraging the infrastructure those companies have built. So no matter what, they're here to stay, and there's very little that can stop their momentum.
That said, James, it does seem like it was kind of a tale of two different types of companies, the big tech companies versus the small tech companies. I mean, you saw what happened with Facebook's report and Alphabet's report, Microsoft's report, and then, of course, Amazon's report, and at the same time, what happened to Spotify, to Pinterest, and to Twitter. So where's the divergence there? What's going on?
Yeah, what we're seeing right now, I mean, the market has gone absolutely straight up for over the last year. Every single thing that was thrown at investors was dismissed. Depressed earnings for 2020, regulatory risks, the election uncertainty. We had a couple of blips here and there, but it's essentially gone straight up. And then now you tack on inflation concerns as we look into the coming weeks and months. Obviously, some of those stocks that you just named, they're higher multiple stocks and more sensitive. But ultimately, when you do look at the underlying performance of those companies, particularly Spotify, that's one that we actually added to on the pullback because of their audio platform that they're building and positioning, we think, relative to Apple Music. But the results clearly are strong, but the multiples attributed to these stocks maybe pricing in an increased discount factor, as we have some outstanding risks as we look forward.
So I'm going to go through a quick laundry list. Apple, did you add to the position? Did you reduce? What's your take there?
Well, I'll tell you, what we did when we turned into the new year, one of the things that we did was we knew that the market was going into a rotation trade, going into the travel space and airlines and things of that nature. But those businesses we didn't think are sustainable. So what we did was we sized up our highest conviction names like Apple, like a Whirlpool, like an Amazon, like a Facebook, gross them up to 10-15% position. So huge sizable weights within the portfolio, given our conviction of those names. So we haven't sold any, but they remain super concentrated as part of the book.
So that's
we
true.
Can go through your list.
So that's true
Apple,
so that's Apple, Amazon, who else?
Facebook, Whirlpool. Those are our top four.
Okay.
Yeah. It's over 10% weights each.
Okay.
How does the rest of the year look like? I mean, here we are at a point where equity markets are just blowing past expectations that analysts set at the beginning of the year already. These are high expectations that these companies have to deliver on. Are they going to be able to do it?
I think the short answer to that is yes, because technology can and will always move forward. So no matter what type of market blips that we see, the world is moving toward the cloud, and the world is moving toward flexibility and enhanced productivity. And any businesses that allow you to augment and optimize that productivity and flexibility via companies that either build the cloud or leverage the cloud will continue to benefit. But from a macro sense, we do have cause for concern. Whenever you open up the economy, when you shut it down and open it up with a flip of a switch, there is going to be a huge bottleneck on the supply side. So inflation, even though the companies that we are investing are deflationary, which gives us confidence in them, but we will likely have inflationary risks near term, and some of these stocks that do have high growth, super high growth, and high multiples associated with them could certainly be under pressure. The analogy we make is kind of like a traffic accident. Even though you clear the accident, it will still take a lot of time for the traffic to clear up. And that's kind of how we're thinking about the supply constraints of the world and what the implications on pricing and inflation and associated interest rates.
Hey, James, how do you make sense of kind of old economy, new economy, Ford versus Tesla, or, Whirlpool? That's an old economy, but they definitely benefited during the pandemic. We've talked with the CEO on air, and he says folks have been at home cooking and spending more time at home. He doesn't anticipate that's going to change anytime soon, that consumer habits don't change that quickly. But it's an old economy company versus, an Amazon where we can shop online and do things differently. How do you make sense? How do you make investment decisions? Because you've got a little bit of both in your portfolios.
Yeah, it's Whirlpool, it's interesting. It's not really a tech company per se in the traditional sense, but
it's a savior in my house if I've got a dishwasher though and washing machine. Just gonna say.
Well, the changes they're making on the production side, they're getting much more efficient in their manufacturing capabilities, and they have been the low cost manufacturer of appliances, and the more efficiencies they're able to drive on that, they'll be able to improve their asset turnover and in turn see appreciation in the shares, and you've been seeing that. But as far as the new economy versus old, really the way we look at it is boiled down to their DNA. Are they willing to make the sacrifices that may cause near-term pain in terms of margin and growth, to be able to adapt, or are they going to be stuck in their old ways and try to eke out as much cash flow as possible? A company like Intel, for example, they're actually trying to rip the Band-Aid off and become something new, a manufacturing company that could ultimately hurt their profit performance over the near term. So it really boils down to, if it is a legacy company, are they willing to adapt? If the answer is no, then they're out. If the answer is yes, then we'll take a look. And as far as the new companies go, are they aligned to take advantage of the cloud and be able to grow their customer base independent of geolocation and continue to pass on ultimately consumer surplus with respect to time savings, because ultimately anything that saves you time wins. So if you look at any company that is succeeding right now, they save businesses or consumers time in some way, shape, or form.
All right, we're going to leave it on that note. James, nice to check in with you. Have a wonderful weekend. James Chakmak, he's partner and technology analyst at Clockwise Capital, on the phone from Miami. We do this with just a few minutes left in the trading session. Coming up next, we're going to be joined by our Bloomberg TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and on YouTube, counting you down to that closing bell.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
Just about 2 minutes away from the end of the trading day, the end of the trading week and month. I'm Caroline Hyde. Taylor Riggs is with me. And of course, we are counting you down to the closing bell right here. We are now going to take you beyond the bell with a global simulcast. You know it. It's Carol Massa, Tim Stemovic with us, bringing us together, the Bloomberg television, radio, and YouTube audiences worldwide. We pass through the most crucial moments of the trading day, guys. And Carol, no earnings to be running through today. Instead, we digest this market pulling lower. Dare I say it? Month-end flows.
Yeah, you can say it. Absolutely. I mean, we are wrapping up quite a week, too, as you said, with earnings. Maybe there's some adjustments here. But I also think investors, potentially taking a breather. What's interesting for the week, Tim, energy, communication services, financials, those ultimately were your top performers.
Yeah, they were. And, Carol, I also think that today markets were just grappling with those comments from the Dallas Fed President Robert Kaplan saying that the Fed should start talking about tapering bond buying soon, saying he saw excess and imbalances in financial markets. Made us think to those comments that Fed Chair Powell said earlier this week when he said, quote, froth in some areas, Taylor.
And despite some of the come down from that froth, we have to also note that it is the end of the month and we're still having one of the best months that we've had since November. Caroline, posting 3 straight gains, mostly across all 3 of the big major averages. So the pullback today doesn't even do enough to begin to describe. Look at that. Love how that team, for our radio audience, our team just pulls up the chart, Caroline, the minute we hint at these.
Thereabouts on the NASDAQ. The S&P 500 off by 0.7%. That's 30 points lower on the day. Even though we get calls, of course, to see this index go higher for the year. Dow Jones off by 0.5%, 181 points lower. And let's take it out to the Russell 2000. This is where your underperformance came. Every industry group on the Russell 2000.
I do wonder, too, what it says that when you look at the week overall for the major averages, the Dow down about 0.5%. The S&P, call it flat or unchanged, as Taylor likes to say. NASDAQ down about 0.4%, despite the gyrations, despite the big tech names, despite all of the big earnings and some big moves in some of those players. We are essentially little change for the week overall. I think that's very telling about investor sentiment right now,
Carol,
guys.
huge correction. It is not unchanged. It is
I can't say it.
Mostly red on the screen. We go to the bottom of the screen and again, mostly red on the screen. We go to the bottom of the screen and again, technology is off almost 2%. Semiconductor and equipment off about 2.6%. Caroline, a lot of this, of course, Skyworks and Cirrus Logic, Carol, as you mentioned yesterday, some of these big Apple suppliers, but, well, they're hinting that the bad news, it may not be over just yet.
All right, I know our producers are going to be mad at me because they're like, don't pick names that are going to change and be in the red. But listen, Amazon hit an intraday record today. It was up to about 2.4% at its highs. It had a blowout quarter, folks. We read, broke it down yesterday. Nonetheless, by the end of the day, down about 0.1%. Got to mention Tesla. Reported, of course, Monday. The stock sold off on that, but it was definitely a gainer. There was some analyst research that was really looking into maybe how many vehicles that they will report. Ultimately, a little bit longer term, 1 million vehicles, and that gave some support to the market. Also, some analysis from NIO, which is a Chinese electric vehicle maker, also gaining big time in today's trade, and that might have given a little bit of support to Tesla as well. Got to mention Overstock. That's my number 4 gainer today, or number 3 gainer since Amazon was down, rallying after its first quarter EPS. Tim, beat estimates.
Well, let's talk some gainers or decliners here, Carol. After those gainers, Twitter, we've been talking about it all day since those earnings yesterday. Twitter shares absolutely plunging today, more than 15%. Sales were slow in the first 3 months of the year, but the company also gave a disappointing outlook, and that's what has investors concerned. Chevron sliding more than 3% today. The company did meet analyst estimates for the most recent quarter, but investors who wanted to see a revival of share buybacks buybacks were disappointed. We made reference to earlier those Apple suppliers, a tough day for some of those today after they reported earnings. Skyworks gets half of its revenue from Apple, down more than 8% today. Cirrus Logic sinking 16%. That company, Caroline, gets more than 90% or nearly 90% of its revenue from Apple.
And you know, Tim, what's also lower on the day? Well, basically most FX pairs versus the US dollar. Today was a story of dollar strength as we looked at that PCE number, that all-important inflation reading that actually the Fed looks at, coming in at 2.3%. That's pretty hot. Meanwhile, we also get the spending, the disposable income rising for those in America, and also we get the hawkish tones coming out of the Dallas Fed governor and president, of course, Kaplan. Remember, he is a hawk on general, but again, it just reminds you that perhaps this is an economy that is running hot. What of then tapering talk in the future? Dollar index for our radio, our YouTube, our TV audiences up 0.7%. So dollar higher, even though it's generally been in the lower trajectory for the beginning of 2021. That means most of your other pairs are lower. The euro off by 0.8%. Norwegian kroner, of course, affected by oil prices, also off by 1.6%. And the British pound, political risk I'm hearing of here in the UK. That's what analysts are talking about as sleaze seems to be encompassing the Prime Minister over here in the UK. Meanwhile, I'm also looking at commodities spectrum for you. WTI crude off by 2.3%. Oil, again, a narrative that is building. India, we see continuing concerns about COVID over there, and indeed, oil goes lower as dollar goes higher, as do most of the commodities. And I leave you with global bonds, Taylor. Actually, a bit of a bid for bond market. We saw a sell-off in Europe, a sell-off in Asia, maybe a bit of a search for a haven today, Taylor.
Oh, as Carol says, unch on the day.
Always Taylor says unch.
But we take a weekly look, and the story does look a little bit more volatile. Remember, we're now lower on the week. We just came off of 3 straight declining yields that we had, and so yields now actually migrate higher for the week on the 10-year, up 7 basis points. Similar story on the 30-year yield. We were lower on yields for 5 straight weeks, now higher on the week for about 6 basis points or so. So you're seeing some of that Fed doing a very good job of walking that line, but on a weekly basis, you did start to see, Carol, some of that higher economic growth, higher growth expectations really filter in through the bond market this week.
Yeah, no doubt about it. Let's not forget we're going to hear from Fed Chair Jay Powell on Monday. He'll be making some comments. Let's talk about, though, Taylor, you mentioned the economy and the economic data. That surge in personal income up 21.1%. We saw following a 7% decline in February. So just taking off March. But we know what's going on, Tim. It's all about stimulus payments. We heard it from the Chipotle CEO. We hear it from a lot of other CEOs that those stimulus payments are really giving some support to consumer spending and certainly to consumer income.
Yeah, it turns out when you give people money, they end up getting more money and they end up spending that money. I think it's also a big reason that we start to see comments from companies like Amazon, the company beating expectations with its outlook for the second quarter of the year. And for the most part, earlier in the day, sending shares higher. But I also think it has to do with the idea of actually finding employees right now. It's something that we've talked a lot about and we've heard a lot about from company executives, that they're having a hard time finding employees despite the fact that there are more than 8 million people unemployed. They're pretty comfortable right now for the most part, a lot of those people.
Yeah, it's real intricacies within this labor market, of course. All important labor data coming out next week at the end. NFP numbers, non-farm payrolls, we all look to that. But also what we look to is not only personal income and some of the inflationary pressures today, but also this week, Taylor, just big tech winning out in terms of its earnings, but not always performing that well. And also what was a key laggard on the week, when I look at the S&P 500, what dragged us lower for the 5 days, it was Infotech, technology names, some of those Apple suppliers that you've been talking about all day, really hurting on the day.
And I think we have a chart showing about 98% of companies so far. Look at it. Look how good this team is. I mentioned the word chart, and Tim, they just pulled up for our radio audience. We'll put this out on social. 90% of these companies are beating earnings expectations. Caroline really nailed it on the head when she talks about some of the big tech companies. Despite those high expectations, they crushed it, they killed it. Though some of the smaller companies, you're thinking of Twitter, for example, that we've been talking about, well, maybe sees, more headwinds ahead.
Yeah, and Pinterest, for example, as well. It's kind of a tale of 2 different types of tech companies. Yeah. I think a lot about brand advertising and the idea that following the January 6th attack, and we heard this from Twitter yesterday, that brand advertisers didn't really want to be actually pushing it out, pushing out their message. Whereas you have a company like Google and a company like Facebook, they can do that much more targeted advertising. It certainly benefited those companies, and we saw it play out in earnings this week.
Yeah, for the week overall, Amazon and Facebook, they were gainers. Pinterest and Twitter, not so much. All right, that's going to do it for the cross-platform coverage, our cross-platform coverage right here on Bloomberg Radio, Bloomberg Television, and YouTube. We'll see you again on Monday, same place, same time.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, so it has been such an amazing week. Fun to check in with our TV team and colleagues because so many different earnings. But, you know, if you really do look at the numbers, it wasn't the same. It was a tale of two tech groups. Amazon was up 4% for the week, Tim. Facebook was up 8%. eBay, though, down 8%. Pinterest down 12%. And Twitter down 16.5% for the week.
Spotify also a big loser after earnings this week, a big laggard.
Yeah, and we'll see what happens. We'll start to get some small cap names next week. But that monthly jobs report on Friday will tell us a little bit about how many more workers are coming back. We know 7-8 million still out of work, have to find jobs.
Yeah, and I want to clarify something that I said just now in our simulcast. It's not necessarily that these people are comfortable. It's that they're not necessarily having the incentives because they can't make they can make more money or a significant amount of money actually not going back to what they were doing before.
It's a thing. That's no doubt about it. Hey, you have a great weekend.
Thank you. You too.
Enjoy.
Thanks.
All right, Tim Stenovic there, my partner here on Bloomberg Business Week. Right now, though, back to world and national news and to Nancy Lyons in D.C. Hey, Nance.
Hey, Carol. Micaiah Bryant was remembered today as family and loved ones gathered in Columbus, Ohio. The 16-year-old was fatally shot last week by a white police officer. Body cam footage showed Bryant with a knife. Senate Republicans are pushing back in an effort to update the American history curriculum with a focus on the effects of slavery. Bloomberg's Nathan Hager reports.
According to Politico, nearly 40 GOP senators, led by Minority Leader Mitch McConnell, have signed a letter to Education Secretary Miguel Cardona. They object to a proposed rule in the Education Department that mentions the New York Times 1619 project. In the letter, the senators say the rule doubles down on divisive, radical, and historically dubious buzzwords and propaganda. 1619 is the year the first African slaves arrived in the American colonies. In Washington, I'm Nathan Hager, Bloomberg Radio.
President Biden is celebrating Amtrak's 50th anniversary. He traveled to a train station in Philadelphia, noted his long-running love affair with trains. He says the U.S. is behind the curve, though, compared with China.
China already has 23,000 miles of high-speed rail, 220 miles per hour, 2/3 of all the high-speed rail in the world.
Biden says his plan will create good new jobs in upgrading rails, highways, bridges, ports, and airports. With the rise of coronavirus cases and variants in India, the U.S. says it will restrict travel from the country starting May 4th. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts.
Thank you so much, Nancy Lyons. So our Bloomberg Business Week weekend show features an interview that we did with Nina Shaw. She's founding partner at Blacklight Collective, and she talked about the lack of diversity and inclusion in Hollywood. In this excerpt, Shaw explains how a study by McKinsey uncovered the staggering financial impact. Check it out.
The wonderful thing about this study was that it really dug in, and it took a look at the numbers, and I think the number that stands out for all of us is this notion that $10 billion in annual revenues every year is being lost as a result of the lack of diversity in the business. And that's something that should appeal to all of us as something that can be cured. One of the report's conclusions is that these are tough problems to solve if they're being done within insular organizations, that it's going to take a collective action across many of the businesses in the industry to really address these solutions. And the first step in that, of course, is acknowledging that these problems exist and that they have a tremendous financial impact. And we're so grateful to McKinsey for having done the work that really allows us a launching pad for real change. Now, we've seen progress. You see more people on screen, and that is a good thing. It is still not as good as we would like it to be, But we must not forget that those gains that we're making in front of the camera need to also be behind the camera and in the C-suite. And one of the things that people say to me when they read the report that really knocks them out is that how the entertainment industry is actually behind many other sectors of the economy in terms of its diversity and inclusion.
And that was Nina Shaw, founding partner at Blacklight Collective. Blacklight Collective did this survey and study with McKinsey, and you can hear more of that interview, the complete interview, on our weekend show on Bloomberg Radio and also on our podcast feed at Bloomberg.com. You'll also hear from McKinsey's partner, Sheldon Lin, who also commented on their findings. You're listening to Bloomberg Business Week. I'm Carol Masser, and this is Bloomberg Radio.
headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World headquarters, I'm Charlie Pellet. It is on to the trading month of May. Today, stocks fell from a record as traders assess corporate earnings, economic data showing potential inflation pressures, and hawkish remarks from a Federal Reserve official. S&P trimmed its biggest monthly advance since October. Energy and tech shares led declines today for the month, though the S&P up by about 5.2%. Twitter tumbled as the social media company posted a sluggish start to the year in its ad business. Twitter shares plunging today by 15.2%. After earnings yesterday, Amazon lower today by 0.1%. Amazon spent much of the day trading higher. S&P lower by 30, a drop of 0.7%. The Dow down 185, lower by 0.5%. Nasdaq down 119, a drop of 0.9%. 10-year yield 1.62%. Gold down $4 the ounce, down 0.1%. 1767. West Texas Intermediate crude down 2.3%. 63.50 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you. So our listeners and viewers on YouTube might recall that I recently caught up with the president and CEO of Siemens U.S., Barbara Humpton, to talk about how work is shifting. Now, Barbara is someone who is talking with leaders, CEOs, about making their workplaces safe, also making schools safe, planning for the next crisis as well. She is back with us today. Delighted to have her. Barbara joining us on the phone in Washington, D.C. Barbara, how are you?
I'm doing well, Carol. Great to be with you again.
Well, it's great to have you here. It's been a big week, a lot of earnings. We had a Fed meeting, but we also heard from the president talking about his American jobs plan, and calling on Congress to, think about the future when it comes to the United States. That includes things like semiconductors, that includes manufacturing. Tell us how you see it, because you talk to a lot of leaders at companies that kind of cross all of these intersections.
Yes, at Siemens, we're really deeply engaged with all of the critical elements of infrastructure you're hearing discussed today. And earlier this year, I actually wrote an open letter to government leaders outlining some suggestions that we have, a broader vision for America's infrastructure, because this is a moment to make those investments. And I shared our support in investing in manufacturing, enabling a new era of electric vehicles, getting cleaner and more resilient energy systems, and transforming America's buildings. And I was pleased to see so much of this aligns with where the executive office is going and where the federal government is likely to head, with the support of our legislators. So, here we are at this moment of deciding what shall we invest in. And this week I decided it's the right time for me to raise my voice more clearly on the subject of manufacturing. This idea that manufacturing in and of itself is a key element of our infrastructure and key to developing the workforce of the future. And I'll tell you, at Siemens, we've got this perspective not only as a manufacturer ourselves, with 24 manufacturing sites across the U.S. and 40,000 people all across the nation, a supply chain with 24,000 U.S. suppliers supporting this backbone of the U.S. economy, but we're also helping 90% of the Fortune 500 industrial companies with our hardware and software that's helping America really adapt to the new digital revolution that's underway. Right. So this is our moment.
So where do we get it wrong in the United States when it comes to manufacturing? As you said, 24 manufacturing sites nationwide for Siemens. So what do we do wrong here in the United States when it comes to manufacturing, or making it more hospitable to, more places?
Well, I think our incentives have changed. If you had looked back over the last 2 decades, you would have seen American businesses making decisions on a global scale. Where can we find the lowest cost location for the bulk production and the supply side economies of scale that are going to drive costs down? And by the way, all of those are very useful goals to have. But what we've seen now, especially due to the coronavirus crisis, is the fact that we need not globalization so much as glocalization, the idea that we need to produce things closer to where they're needed so that we're not dependent on single points of failure in a global supply chain. We have an opportunity now to turn that around. And people have been asking me, are we going to be onshoring or reshoring? And what I keep reminding people is I think what needs to happen for many manufacturers is more of an and than an or. We do need to serve people around the world close to where they are, but we also need to bring the ability to manufacture right here close to where we need the goods and services ultimately.
So I'm going to play devil's advocate a little bit, but I can see companies gearing up already to say, but wait a minute, now you want us to tax more, but you want us to build plants in the United States and provide jobs. And the president makes the case that a lot of corporations get off easy when it comes to paying corporate taxes. And if you look at the data, we've certainly reported on it here at Bloomberg, that is often the case where companies through, various maneuvers and loopholes are able to pay a pretty low rate. What do you say to that?
What I say to that is this is a moment when business needs to show that we are responsible. We have to step up and have a mature dialogue about this. Siemens, for our own part, we are responsible taxpayers, and we are really advocating that our tax code represent a regimen that will put us on a level playing field with the rest of the world. So, we of course are not going to be advocating for off-the-charts tax rates for corporations when it would actually cause investment to flee the company. But let's say we can work with other nations, find tax code levels that are going to be equitable, provide that kind of level playing field, and then also really incentivize investment in the U.S. At Siemens, we've invested $40 billion over the last 2 decades in America. And what we're finding is that if we make these investments, then the growth comes, the health, the prosperity comes after. These are good investments for us to be making, particularly in a time of transformation like this one.
Great stuff. Barbara, we're going to continue in just a moment. I'm going to do a little bit of news, but we'll come back and continue with you. Barbara Humpton is with us. She is President and Chief Executive Officer at Siemens USA on the phone from Washington, D.C. Quick check, though, and reminder of how we closed on this Friday, of course, wrapping up the trading week, one that was packed with earnings, packed with a Fed meeting and a presidential address, I should say, to a joint session of Congress. S&P 500 closing down 30 points, 0.7% here. Dow Jones Industrial Average down 185 points, down 0.5%. The NASDAQ down almost 120 points with a decline of 0.8%. We're going to continue with Barbara Humpton over at Siemens USA, and then we're going to finish up with Nancy Wilson on this Friday. You're listening to Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
And coming up, we're going to get back to our conversation with Barbara Humpton. She's president and CEO of Siemens U.S., talking about bringing manufacturing or cultivating it more in the U.S. specifically. I also want to ask her about digital twins, because I am guessing we're going to be talking a lot about this in the future. We'll continue in just a moment. Right now, though, back to Charlie Pellett, who's been summing up what a week it was, Charlie.
What a week indeed. Down day on Wall Street, though, with the Dow, the S&P, NASDAQ all declining. On the positive side, though, for the month of April, up 5.2% on the S&P today. Those stocks fell from a record as traders were assessing corporate earnings. Case in point, Twitter plunging 15.2%. Amazon, after earnings, spent much of the day higher, ended with a loss of 0.1%. ExxonMobil reported this morning, down today by 2.9%. In addition, investors were analyzing economic data showing potential inflation pressures and hawkish remarks from a Federal Reserve official. End of the week, end of the month numbers here. S&P down 30, ending the month at 4181, down 0.7%. The Dow down 185, a drop there of 0.5%. NASDAQ, you guessed it, down 119 points, drop there of 0.9%. 10-year yield 1.62%. Gold down 366 the ounce, a drop there of 0.2%. 1768 on the precious metal. West Texas Intermediate crude down 2.3%. 63.50 for a barrel of WTI. Busy week though for tech earnings is behind us. James Chakmak is technology analyst at Clockwise Capital.
We saw all the big companies reporting this week: Amazon, Apple, Facebook, Microsoft. And I think the big overarching takeaway from those is that these companies are proving to be increasingly essential to the world, and the results certainly prove that.
And again, recapping, S&P down 30, a drop today of 0.7%. I'm Charlie Pellett. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Let's get back to our guest. We're talking with the president and CEO of Siemens U.S., Barbara Humpton. She still is with us on the phone in Washington, D.C. So, Barbara, we were talking about the president's American Jobs Plan, manufacturing here in the United States. And I'm thinking, after a week like we've had, so many different earnings and hearing from so many different companies, whether it's Apple, BMW, Ford, when it comes to the global chip drought. And, you know, we know specifically that companies like Apple and Samsung talking about production cuts and lost revenue because of the global chip shortage. Tell us about the situation in the U.S. You guys have a great vantage point. How bad is it, and how quickly, or what will it take for us to ramp up production so that we can address some of these shortages significantly?
Yeah, this is a real issue because, as you know, semiconductors are used in everything: cars, planes, computers, batteries. I mean, the toothbrush that you
exactly.
So we're
there may be a few in me. I'm not quite sure at any given time.
We are highly dependent on this technology. And back in the 90s, the U.S. had about a 27% market share of the worldwide market, but now we're down to a mere 12%. So this is one of those areas where this would be a wise investment. It's a matter of national security. And by the way, the U.S. security is key to global security. So an investment here is critical for all of us. And so one of the things we're promoting at Siemens is support to the CHIPS Act. The idea that there would be incentives for local manufacturing. The Department of Commerce is putting their full weight behind us to locate key semiconductor manufacturers here. I know there's work already going on in Phoenix. There obviously are needs for projects elsewhere. These are large facilities. It costs tens of billions of dollars of investment to stand up the manufacturing, but well worth it when you understand that truly this digital economy rides on this technology.
It's interesting that you say, I'm thinking about what you're saying, and we talked about what needs to be done here. You know, we reported, I think it might have been on April 28th, but in a dizzying 12-hour stretch. Honda said it's going to halt production at 3 plants in Japan. BMW cutting shifts at factories in Germany and England. Ford Motor reducing its full-year earnings forecast due to the scarcity of chips. Caterpillar flagging it may be unable to meet demand for machinery used by construction and mining industries. I am reading that because it is a global problem, and I do think about what Japan might do, what Germany, England might do, China might do, what other countries will be doing to address these chip shortages. And I say that because I think it's pretty obvious that President Biden is laying out this plan thinking about how do we keep U.S. and U.S. companies competitive.
That's right. We have to consider our place in the world. We do have a responsibility with all of the innovation that happens here. It's going to be vital that we have a supply, and hence these kinds of investments are going to be critical for us. But I'll add to this that we this year have really come to appreciate our supply chain and logistics professionals. I mean, if you weren't hearing about them previously, between everything we've been through with the pandemic and now semiconductors, what you realize is that we have, there's a whole market segment devoted to the proper disposition of rare supplies and assuring that we prioritize and get things to the right place to keep operations running for many of these critical industries.
No, it's interesting, right? The financial crisis reminded us how important the chief financial officer was because they had to watch the books, make sure liquidity was maintained at firms. And I think it's fair to say that the past year has certainly stressed how important the supply chain and those logistical people, are important to kind of keeping things running. Before you go, because when we have a guest like you have a great, as I said, vantage point to what's going on in many walks of our life here in the U.S. and certainly a vantage point when it comes to manufacturing, but also some of the new terminology that we might be using more in the future. Digital twin, just address that, remind or tell our audience what that's all about.
Yeah. Well, let me ask you this. Did you watch the landing of the Mars rover, and did you watch the first flight of a helicopter on Mars?
Mm-hmm. Yes.
Those milestones were made possible by digital twins. In this case, Siemens helped NASA and JPL actually model the actual rover and helicopter as they would perform on Mars. And they created in virtual space a digital twin of each of them, and then put them into a digital environment to simulate the conditions on Mars, which we really can't replicate here on the Earth. So only through computer simulation were we able to know with confidence that those new inventions would succeed the way they did. And wow, what an achievement. Yeah. So it's not just Mars rovers that and can take advantage of this. It's everything from ventilators needed during the coronavirus to the pharmaceuticals, to the testing the FDA will now do as they consider the use of new drugs or new medical devices. We have the ability to create digital twins. Just as we've all been playing video games and enjoying a virtual world, that's gone big time in engineering, and it's going to change the way we approach these fields in the future.
Well, we will continue talking about it. I know we'll have you back more in the future to continue this conversation as well. Barbara, thank you so much for finding time for us again. Barbara Humpton, she's President and Chief Executive Officer at Siemens USA, on the phone from Washington, D.C. We're going to stay in the nation's capital, check in with Nancy Lyons for World and National News. Hi, Nancy.
Hey, Carol. Well, for security reasons, President Biden now flies home to Delaware. But for all his years in the Senate, he commuted on Amtrak. And today he paid tribute on the 50th anniversary of the nation's passenger rail system. Bloomberg's Irv Chapman has more from Washington.
The president reminisced about his friendship with Amtrak conductors and personnel who were once his daily companions.
We have a once-in-a-generation opportunity to position Amtrak will play a central role in our transportation economic future. But there is still a huge backlog in deferred maintenance, huge need to modernize our trains, our stations, our bridges, the Hudson River Tunnel, the Baltimore, Potomac tunnels, and the Susquehanna River Bridge.
The president spoke at Philadelphia's 30th Street Station, standing in front of Amtrak's newest Acela train, built in Hornell, New York, by a French company. In Washington, Irv Chapman, Bloomberg Radio.
A suburban home along Houston's Southwest Freeway is the scene of a human trafficking investigation this afternoon. Houston Houston police were tipped off to a possible kidnapping at the home, but when officials executed the search warrant, they discovered more than 90 people crammed inside the house. Houston Assistant Police Chief Darren Edwards says investigators are still trying to find the suspects.
Got to separate who the victims are versus who, as you can imagine, somebody that would be involved in something like this, as soon as they realize we're here, they're probably going to try to become a part of them, right? And so we've got to be able to identify.
Edwards says those found in the home are also being tested for the coronavirus. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
Well, he's a voice we've talked to a lot over the pandemic, and our Business Week Weekend Show features an interview once again with John Taffer, host and executive producer of Bar Rescue. In this clip, John Taffer talks about seeing a summer recovery for the restaurant industry. Listen up.
There are shining little spots here that are moving in good directions, and I'm forecasting a pretty darn good summer.
Well, okay, so wait, do we get then to pre-pandemic levels this year, or is it more a 2022 story?
Well, I think there is some regional impact upon this. Okay. We take a look at markets like Florida, Miami. I think we do come back to pre-pandemic levels. But, I think that markets like Las Vegas, we come back to pre-pandemic levels. Let me put an interesting premise out at you. It's how we define pre-pandemic levels. Let's say we lose 38% of our restaurants and bars across the country as a result of the pandemic, and the marketplace comes back to 80% of its previous level, Carol. We have 38% less capacity for a marketplace that's only gone down 20%. So to me, those are pretty good numbers, and it looks like the restaurants that survive land in a pretty strong place come this summer. There's also a residual effect upon our industry that a lot of people aren't quite talking about yet, and I'm going to make a bit of a forecast here, and that is, companies typically, and I'll just use an example of one that I happen to know as a friend, like a Panera Bread, for example, prior to the pandemic would have run 5-7% to go. Right. Now they're running about 30%. There's a view that 30% to go business stays and the restaurant fills up again. So, I take a look at that and think to myself that there's a real opportunity to bring back the inside business this year and have a whole new level of delivery business that increases our revenues to about 120% of what they used to be.
Definitely tapped into that Panera to go, I'm just going to say, during the pandemic. You can hear more of that interview on our weekend show on Bloomberg Radio and also at Bloomberg.com. And check out that podcast feed. Check out, too, the season premiere of Bar Rescue this Sunday at 10 p.m. Eastern on the Paramount Network. He is focusing all season on his hometown of Las Vegas. Coming up, a real treat. Nancy Wilson's going to join us right here on Bloomberg Business Week. This is Bloomberg Radio.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pelota. Down day on Wall Street, stocks dropped from a record. Traders were taking apart corporate earnings. Economic data showed potential inflation pressures and hawkish remarks from a Federal Reserve official. Robert Kaplan, president of the Dallas Fed, said signs of excess risk-taking in markets show it's time to start debating a reduction in bond purchases. 10-year yield 1.62%, up 3/32. S&P lower today, ending the month of April at 41.81, a drop today of 0.7%. S&P down 30. Dow Jones Industrial Average down 185 points, a drop of 0.5%. Nasdaq down 119, a drop of 0.9%. Gold down $3 the ounce, lower by 0.2% to $17.69. West Texas Intermediate crude down 2.4%, $63.49 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So that's the title track from Nancy Wilson's first ever solo album. It's entitled You and Me, the track in the album. Nancy, of course, along with her sister Anne, are the iconic rock band Heart in the Rock and Roll Hall of Fame. They were touring just before the world shut down because of the pandemic, and during the past year, as the world stopped, Nancy produced this new album, working at her home studio. It will be released May 7th. Let's get more, because lucky for us, joining us is singer-songwriter Nancy Wilson, also author of Heart's 2013 memoir, Kicking and Dreaming, and she joins us on Zoom in Los Angeles. Nancy, so nice to have you here with us. How are you?
I'm good. How are you doing over there?
We're doing okay. You know, we're feeling like things are starting to reopen a little bit. How does LA feel? Yeah.
Well, I'm in Northern California now.
Oh,
We
okay.
moved here right in time for the shutdown, actually, which was a very lucky thing for us, because we got to kind of get out of the big city, which was maybe a little more scary to be there then.
Yeah.
But now it's been going well. There seems to be some light at the end of the tunnel, because of the vaccines, obviously, and following all the rules and the protocol is working. So it's really a beautiful thing to be able to say, go inside in a restaurant, and with a mask, of course, but
right.
And we dined for our anniversary the other night. We went and had dinner at our favorite restaurant, and that was really oh my God, really exciting.
Right, like getting back to quote unquote normal. It's interesting, over the past year, a lot of musicians, and it sounds like yourself, once you found your footing, have been very creative and productive over the past year. Tell us about this new album that you are putting out.
Well, I started realizing, after we moved in and we realized we might be here for a while, shut into our home, and not daring to go out and even touch anything, or just all of the fear at the beginning of this thing. But I did have a new space to do music in, so I got my stuff, out of storage. I pulled it into my space. I got my best guitars out. I got my amps out, and my pedals, and my microphones, and my new interface. A friend of mine knows how to run for me, and just a real simple gear, and just the simplest. But, the old guitars that have the good sounding dirt in them, and the old amplifiers that have the good sounding dirt in them. And decided to start writing again, since a lot of people have said, why aren't you going to do a solo album ever? You've never done it yet. So only a live thing once, but that wasn't a studio album. And so I started to write. And the first thing I wrote was called We Meet Again, which I thought was kind of a long view at the horizon of your life a little bit, and feeling like when you have somebody that you love, that you're going to be there you're going to be there for them, and they're going to be there for you for the entire ride. So I thought it turned out nice, and so I kept writing and I kept writing. And then I decided to do The Rising, a Bruce Springsteen cover.
Right.
Pretty early on, because I saw how the world was suffering and how that song had been written for 9/11 originally, which I thought was really appropriate for the times.
Right.
And it might be something maybe a little aspirational for people trying to get through all of this loss and all of the fear and all of the suffering involved in this whole whiplash of experience we had to be tossed into, you know. So I think it's sort of a woman's voice singing a song like that was even more kind of mothering and nurturing and aspirational. So that's kind of where it started out, and I just kept on building songs.
Well, tell me about, because it really does feel like a very thoughtful, very deep, and very reflective of what you were going through. And I think it will, I think for people who listen to it, will feel some connection easily with things that they were going through. And one of the things I think about the past year, we lost some really incredible people in the music industry, and you have a tribute to Eddie Van Halen. Let's talk about that.
Yeah. Well, somebody said, you've got to do an instrumental song on your album, which I said, okay, you can twist my arm, you know, because I love just playing instrumental stuff. Because I did a lot of scoring of movies before in the past, and it's a great thing to be able to transition between songwriting and just instrumental writing. So somebody said, okay, I agreed to do it, and then I said, and not only that, I'm going to dedicate it to Eddie Van Halen. And then I was like, why did I say that? Like,
yeah.
I was like, oh no, now I've really painted myself into a corner, you know, because I have to actually come up with it and figure out how to do it. And
you did.
So I really avoided it.
Yeah.
I avoided it. I procrastinated as long as possible. I finally got my head around it when I thought about, you know, I listened to Eddie. I listened to Van Halen songs, and I watched a bunch of his footage, and I thought, well, here's something I know that I could try to do is something in a very happy key. Like his music was all very major key stuff. You don't hear a lot of blues licks, you know, in Van Halen songs. You hear positive, forthright, jubilant stuff. So that helped me figure out like how to find the right key, the right tuning, the right structure, where you a little bit of a classical, a little bit of rock in the middle, and then a little classical at the end, and not too long. Like in scoring for film, with anything without lyrics in it, you know, might tax the listener a little bit. So
Right.
I kept it short and sweet, and just for Edward.
Yeah, I love the title, For Edward. And, I mean, you guys toured together with Eddie Van Halen. I mean, do you have a story, a memory, you know, or remember the first time you met him?
Well, we did tour a bunch of different places and times together, and we always found each other hitting it off, you know, like backstage or, you know, at the hotel passing in the hallway, you know. And they were like, hey, come down and have a drink with us in the hotel bar. And so it's like, okay, great, we'll get to know you. And so they were drinking kamikazes. And
Yikes.
I'm like, whoa, what is that? So, here, try one, you know. So like, whoa, how do you drink more than one of those? I'll never know. And those guys were pretty heavy duty partiers. And they were pretty primal with it. They would get all tangled in some kind of an argument, and then they'd start hugging and going, I love you, man. And they were just really primal with their partying. And but they were really sweet guys, and Eddie's a sweet person who was we were kind of fond of each other because he's told me he liked my guitar, my acoustic playing, and I couldn't believe he even said it, you know. And then I said, what about you? Why don't you play more acoustic? And he said, well, I don't have an acoustic.
Which is amazing.
I made a little video, storyteller video about it with the song. But and I said, well, you're going to have this guitar right now because you need an acoustic. So early the next morning when it's just getting light, he calls my hotel room and plays me this gorgeous piece of instrumental acoustic music, which when I was trying to recall that as much as I possibly could do for the For Edward tribute song. So I don't know if I get close, but I got something.
Yeah, no, it's really.
At least I got it done.
It's a really lovely tribute. I have to say, we only have about a minute or so, or a minute and a half left here. You're incredible. I grew up with a lot of music, from Sinatra and polkas to the Beatles, the Dead, Heart, you name it. So, music really shaped me and my family, and I can kind of feel it. I feel like when you talk about it and how it influences you and the people you met. I have to say, one of my favorite things that you and your sister did was the Kennedy Center Honors, when you guys covered the Led Zeppelin Stairway to Heaven. That must have been incredible to do with Led Zeppelin looking on.
Yeah, well, we couldn't, luckily